Gold and silver saw the steepest drop in more than a decade after a stunning rally. With more money seemingly exiting as quickly as it poured in, is the precious metals run over or just taking a breather? Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. With momentum rallies stalling in gold and crypto, could this be a warning sign for equities? We'll put that question to SEB's head of Asia strategy, Eugenia Victorino, and UBS Investment Bank precious metals strategist, Joni Teves. Also ahead, we hear exclusively from KKR's co-CEO Joe Bay on why global investors are steadily shifting more capital to Asia. And power-hungry AI data centers are fueling a global rush for green energy solutions. We discuss this with BNP Paribas Global Sustainability Head Jane Ambachtsheer. Our top story today, gold and silver losing their luster as the precious metals tumble from record highs. Spot gold stabilizing after Tuesday's biggest intraday decline in more than 12 years. Spot silver suffering a 9% drop in the previous session. The pullback brings an abrupt halt to a months-long advance, with gold coming off its 9th straight week of gains. Technical indicators have been showing that the scorching rallies for both precious metals were probably overstretched. Now, here's what some of our guests have been saying about the deepening rout in gold prices.
It wasn't the same cadence of demand that we had seen previously, and the universe of investors in the gold space had expanded quite rapidly.
Well, I think there's a lot to be said about profit taking and momentum just basically slowing down here.
It's likely a combination of factors, and coupled with that, we've also saw some positive rhetoric around US-China trade talks. So it's a combination of factors, but we think technical selling has been the main culprit behind the downward leg that we've seen.
I think a lot of them had to sell because they were adjusting bar. And, let's not dismiss just plain old profit taking by proprietary traders or discretionary traders, if you like.
We do expect gold to regain its upward momentum going into 2026, and we're expecting further highs next year.
I think gold fundamentally looks very good. This whole debasement trade is still very much on.
Mixed views there. Let's get insights from our panel. Joni Teves is precious metals strategist at UBS Investment Bank. Also with us, Eugenia Victorino, who's head of Asia strategy at SEB. Joni, let's start with you. Fundamentals, technicals. What's behind this sell-off in gold? Is it just plain money being taken off the table?
I think the market deserves a bit of a breather here, given the very sharp rally that we saw since the beginning of September. So I think a bit of profit taking from near-term positions, especially ahead of the FOMC meeting next week. So I think it makes a bit of sense. And ultimately, I think it will be healthy for the market to have a bit of a pause here to get ready for sort of the next leg higher.
How are you making sense of it, Eugenia?
It's interesting because actually even before the big move yesterday, we have already been hearing from our Shanghai colleagues that the Chinese price could not really breach 1,000 yuan per gram even last Friday. So I wouldn't be surprised if the moms and pops in China just maybe took profit. After all, they have been active in the gold market since 2024. It was either equities or gold. And we know that the equities in China had only really gained strength in 2025. So there's a lot of profit taking that could have happened.
But why now? Why take profit off the table? I mean, some say gold could head to 5,000. Is it a case of taking profit off the table now only to pour money back into it?
I mean, for the Chinese investors, they're still looking at structural demand for gold because, as I said, it's just gold or equity prices, because we've been on a downturn from the property market for years, and at least for the first time, they're not actually asking anymore when the property market will decline, but there has been some improvement in confidence, at least as far as their investment appetite is concerned. So there has been some reallocation into the equities, but clearly the ETF flows in the China-listed gold ETFs just continued to rise.
Why now, Joni? I mean, if you take a look at the risk landscape, there are more risks out there.
I would expect actually it's more the short-term positioning that has taken profit here, just because of technicals. The rally has been very sharp over a very short period of time. The problem is we don't see that data right now with the U.S. government shutdown. We don't have the data on speculative positioning. But if you look at, I guess, more longer-term players like the ETFs, as mentioned, they continue to be positive, and I would expect physical demand is more long-term in nature as well. So the investment in bars and coins globally, I would expect to be more resilient here.
Some say momentum is something to factor into these moves. You know, we've been talking about how people have been riding the momentum on the way up. People can ride the momentum on the way down too. So the declines that we see could be quite deep.
So I think there will actually be more support on the downside here. There is still, ultimately, the broader market is still underinvested in gold. So we think that there's still a lot of retail and institutional investors that are looking to buy into the pullbacks. Also, physical demand during this period in the year typically is stronger. So I would expect physical markets to buy into these pullbacks as well. So there should ultimately be support.
That's assuming that they buy into these pullbacks, right? Eugenia, what if retail investors, get settled with huge losses? That's another story altogether.
Well, it really depends on how they took the position, right? If it had been backed by leverage, then they would be saddled with huge losses. But as I said, in the case of China, they have been piling into these gold positions.
But that's China. How about international investors?
Okay, well, as far as the retail flows into the ETFs, that only started in the last couple of months. So there is that risk, but we don't really know how they took on that position, given that there is no CFTC data recently.
So, Joni, would you be buying into this sell-off in gold?
I think from these levels, and if we pull back even further, I think it will provide a good opportunity for investors to get in at better levels. We are still bullish into next year for gold.
How deep, though, might this sell-off be? At what level would you consider buying back? Are you waiting before dipping back into the gold market?
It looks like 4,000 is just because it's a nice round number that will initially provide support. I think below that, probably 3,800, where we really started to see that kind of push towards the 4,000 sort of key level. So around those levels, I think would be quite attractive, for investors to start looking to build positions for the next leg higher in gold.
Eugenia, buying the dip?
Well, you know what? When I look at the central banks, they've definitely been adding. So I always tell our clients, if it's good enough for the central bank, it's a little bit difficult to go against the central bank, right?
So 4,000 is the level you're looking at as well to buy?
I'm not a gold expert, but I would say yes. I mean, just because you have a pullback in the near term doesn't necessarily mean that this pullback will continue into 2026. But clearly the momentum, the pace at which the gold prices went from 3,000 to 4,000 was much faster than when it went from 2,000 to 3,000. There has to be some rationality going into this place.
How might this play out in the broader market? I mean, when you take a look at the correlation between gold and equities, for instance, it's meant to be negative correlation, but that correlation broke down about 3 months ago. How do you read into this and the possible impact?
I think it's really reflective of the fact that there is no strong conviction. If you were previously or theoretically, if you're really risk on, you should not be buying gold. And yet, it was risk on AI-related narrative, and yet there's continued flows both of institutional and retail investors into gold. So there was no real narrative that drove that that flow. Therefore, I would think that going back into rationality, long-term correlations should say that if you have a pullback in the gold, there should be an equity rally. In my case, I would expect that there would be some of the Chinese investors going into the equity market because, as I said, it is the equity market that has really been going up.
So
in China these days.
everything rally is not sustainable. That's what
I
you're
don't
saying.
think so.
And the impact, the correlation between gold and the bond market.
Yeah. So gold has historically a negative correlation with real rates in particular. And I think that is stable over the long term, but that has been slightly weaker in the last 3 years because of other factors driving the gold price, such as the strong buying from the central banks, which are not really affected so much by interest rates, and also I guess the very strong safe haven and diversification flows, which again are more resilient to fluctuations in real rates. And I think that's what's weakened the relationship. But I think that's still intact over the long term because it's intuitive, right? It represents the opportunity cost of having that position in gold. And with regards to equities, I think one of the drivers of a positive correlation would be expectations on Fed policy. So the fact that we're all looking to the FOMC September meeting as a beginning of the easing cycle, which was both positive for gold and for equities. And I think that's where you saw that positive correlation. On the flip side of that, once we start looking to the Fed unwinding accommodation, and then I think that will be negative for both gold and equities.
The problem is there's a lack of data. So who knows what the Fed might do? I mean, how do you factor that in, Joni?
I think right now we're just really focusing on other data points that we can use as a proxy. So we're focusing a lot on other, for instance, in terms of positioning for gold, we're looking at ETFs. We're looking at other indicators in the market, indicators of market tightness. For instance, looking at forwards and kind of looking at other, other markets, other data in other markets apart from the U.S.
And Eugenia, the base case is still 2 for this year, 3 for next year. Is there a but?
Not necessarily, because at this point, even though we're only going to be looking at the CPI this week, it is quite clear that the Fed speakers, or the Fed in general, is really more focused on the labor market. The problem is we don't have a real indicator on the labor market. At this point, the Fed speakers are suggesting that they think there is more weakness than what the data is suggesting. But as I said, we're flying blind here. But because we're flying blind, there's nothing that is challenging the narrative of further easing in the Fed.
Might an upside surprise in CPI prompt you to rethink your assumptions for the year in terms of Fed cuts?
Not necessarily.
Why
because
not?
What we've seen is that the upside pressure on the CPI would probably be coming from the tariff impact. And from the conversations with corporates, they have been able to absorb some of the tariff impact. So in the near term, the impact of the tariffs is going to be subdued. Having said that, the labor market is really the main driver for the Fed right now. But it would make it complicated for the Fed if there is a substantial upside surprise to the CPI, because they're flying blind on the labor market and yet you have a surprise here. But in general, I wouldn't really expect it to change the expectations.
Joni, it's not just about gold, it's also about silver. In fact, silver has had a bigger sell-off than gold. How are you reading into that?
So silver is generally a higher beta expression of gold, and that's how. And I think that's one of the reasons why we're starting to get nervous about the rally in gold, because you were seeing also investors piling into other precious metals. So I think, given that gold has pulled back, it is not a surprise that silver has pulled back even more.
But the thing is, silver will be well supported. I mean, it has real life uses, isn't it? I mean, if you're going to choose a metal to invest in, silver is probably a front runner out there.
The challenge with silver is that you are faced with a precarious growth backdrop right now, so that does kind of have downside risks for industrial demand for silver. Also, the second thing that silver doesn't have that gold has is the central bank buying or official sector buying, and that is providing support for gold and has done so in the last 3 years. But you don't have that for silver, so that does make silver a bit more vulnerable on the downside. So I think a lot of volatility in silver, right? Because on these periods when gold is rallying, it will attract a lot of investor interest in terms of catch-up trades. But on the downside as well, it could fall a lot deeper.
Where do you see silver year-end in 12 months from here?
So we have $55 as a target for silver next year.
For end of 2026.
End of 2026, yeah.
So, given the scenario that Joni has just painted, and the discussion that we've just had, how are you positioning given the uncertainties out there?
I've been positive on the Chinese equities since the start of the year because really there has been a substantial change in the narrative as far as the institutional investors are concerned. And at this point, Western institutional investors are still underpositioned in the Chinese equity market. And at this point, we're already expecting that there's going to be a trade negotiation or a trade agreement of a ceasefire. I'm not really expecting any of the export control laws to be pulled back, but maybe just a suspension. And that's going to be good enough to keep the sentiment positive.
What's attractive in that market?
Well, in my view, in Chinese, at least as far as the Chinese market is concerned, it's not only the fact that there is AI that is already being adapted, but I think the Chinese industry is much more likely to adapt and to profit from the AI, not just from the AI investments, because that's the issue with the U.S. market. There's a lot of upside because of AI investments, but there hasn't been concrete monetization of the AI capability. Unlike in China, we clearly see it almost every month. There are news of applications of the AI.
And in terms of demand for precious metals, for instance, which markets do you think will drive that demand?
So I think for gold, I think it's across the board. You're seeing that interest across different regions and across different sort of demand segments.
Especially central bank interest that will gain momentum from here?
Central bank demand, actually, we expect to slow down this year and into next year and the next few years. A combination of, some of these central banks have been active for some time, adding to their gold reserves. They're likely getting closer and closer to their targets. The rally in the gold price also helps them get to those levels, particularly for those that target a specific percentage to total reserves. Having said that, we still think that the sector will be a net buyer, and that's still at historically high levels because the argument for diversification into gold for these central bankers still make a lot of sense in this environment.
Before we go, just to wrap up the conversation, the biggest risk you see for the markets would be, Eugenia?
If there's a substantial data, the totality of the data in the U.S. would actually prove to be much more resilient than we are expecting, because that would mean that would be a recalibration of Fed expectations.
And Joni?
I would agree with that. I think, as stronger than expected U.S. data, which leads to, and particularly a reacceleration of U.S. growth, I think is the biggest downside risk for gold if we're talking about a Fed now looking more towards hiking rates rather than cutting.
Thank you so much for your perspectives today. Joni Teves of UBS Investment Bank and Eugenia Victorino of SEB. Now, still to come, we'll hear from CFO Jason Child on the possible threat of an AI bubble and why he thinks this cycle is different from the dot-com bust. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Bloomberg has learned that Anthropic is in talks with Alphabet's Google about a deal that could be valued in the high tens of billions of dollars. Sources say the plan has yet to be finalized, but could involve Google providing cloud computing services to the AI startup. Alphabet shares jumped in extended trading following the report. Shares of fellow Anthropic investor and cloud provider Amazon, meanwhile, fell. Now, staying with AI, Arm's CFO says the company is the CPU of choice in major artificial intelligence projects from NVIDIA to Oracle. Jason Child also told us that today's AI challenge is supply, not demand, and expects both failures and winners to emerge in the AI space.
If you back up Stargate, I think they said it was going to be something like $500 billion of total spend over 4 years. As of today, we are the CPU of choice. So if you think of, say, Grace Blackwell, or even in the future, Vera Rubin, Grace and Vera, those are both built on ARM from NVIDIA. And then, of course, to the extent that Oracle's also going to be contributing, that's certainly another partner that we could be helping. And then there's OpenAI, and certainly there's, I guess, rumors of custom efforts by them. And for the most part, most of the custom efforts, there's been a lot of discussion about using ARM-based CPUs to pair with those custom GPUs. So a lot of opportunity, and it could be significant.
The numbers, I mean, you mentioned 500 billion.
Yeah.
The numbers are kind of range from 100 billion to 500 billion.
Yeah.
Is there a risk that the revenues realized won't match some of those larger aims and larger aspirations? Possibly. We're not super close to the total spend in Stargate, but if you look at what the needs and uses are right now of AI, compute in particular, supply is far behind demand. And so at this point, I think the challenge is really just about, can you get the power, can you get the chips, and can you get the systems deployed? And so, with that kind of a demand cycle, I expect there's a decent chance that you'll see us at the high end of that. So on that point about supply not meeting demand right now, we've seen these incredible numbers, incredible deals across the infrastructure space from the hyperscalers and OpenAI and many others. On a promised future, but not fully realized yet, does it concern you? I mean, are we seeing an AI bubble?
Okay, so when I think about bubbles, I think about, I was actually at Amazon back in 99, 2000 when things were getting frothy, I think they said. What was interesting there is there was a bunch of build out, but a lot of that build out wasn't really being deployed, or it wasn't being fully utilized. If you think about all the servers, all the websites, the shipping capacity, etc. What's different in this cycle is the problem we have right now is supply, not demand. That was really more of a demand issue. This is really, right now, our challenge is supply. So I think the question is going to be, is there going to be a situation where you have a bunch of companies that probably have raised capital and maybe are pre-revenue? Is there a bunch of those companies that maybe won't make it out? So are they going to be the Pets.com or Home Grocer or Webvan or whatever? Sure, that certainly could happen. But are there also going to be the equivalents of Amazon, Google, eBay, Yahoo, these other companies that actually were, quite large and became, pretty huge companies? I expect that to happen as well. So how we define bubble and who's the winners and losers, I think that's all to be seen.
And that was ARM CFO Jason Child speaking to Bloomberg's Tom McKenzie. Of course, we have Asian stocks under pressure. Take a look at how U.S. futures are shaping up. Of course, we're counting down to that CPI print on Friday that could just help us ascertain the direction of the Fed movements. S&P futures flat right now. Nasdaq futures also lower by 0.1%. Our eyes continue to be on gold and silver, extending the plunge from record highs. Still ahead on Insight, our exclusive interview with KKR co-CEO Joseph Bay. We'll discuss where he sees investment opportunities amid shifting geopolitical dynamics and a weak dollar. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Here's a quick look at where markets stand. We've been talking about that momentum rally, that everything rally. Well, that seems to be breaking down, pretty much led by gold. Gold having its biggest drop in more than 10 years. Gold and silver futures stabilizing after those overnight losses, by the way. We talk about momentum. That was the weakest factor in the U.S. overnight and for the past week, and that's according to the Bloomberg Factors to Watch screen. Take a look where we are in terms of the MSCI Asia-Pac index. It is down about 0.5%. S&P futures also under a bit of pressure there in terms of the dollar. It is pretty flat. We're also keeping an eye on Japanese markets. It is just returning from that lunch break. Investors scrutinizing the impact of Sanae Takaichi's first moves as prime minister. She's ordering today a fresh economic package to help ease the impact of inflation on individual as well as businesses. The Nikkei 225, along with the rest of Asia, under pressure. It is down by 0.4%. Topics, though, in the opposite direction. In terms of Japanese yen, it is trading at 151. It is up about 0.1% versus the USD. Now, New York-based buyout giant KKR says the firm is ramping up in Japan, which is now their most active investment destination outside the U.S. This comes as the buyout giant sees global investors with heavy U.S. exposure steadily shifting more capital to Asia. I spoke exclusively with co-CEO Joseph Bay about their strategy and expectations for Japan's new prime minister.
I think the key in Japan is really the continuity of the policy, really starting with Abe, right? We've had a number of prime ministers since then, but each of these successive prime ministers has continued and expanded the reform agenda here in Japan. And our hope and expectation is this new prime minister will be committed to that same reform path. If that happens, I think the future is very, very bright for Japan.
What's the plan then, Joe? What's the plan for Japan? What is the strategy? How do you grow your foothold in that important market for you?
Well, there's an evolving marketplace here, right? So traditional private equity focused on corporate carve-outs will be our bread and butter. We're seeing more and more activity there. You're seeing more secondary transactions, more public to privates. So I think that speaks to how the private equity industry is maturing here. And beyond that, it's the emergence of new asset classes. So infrastructure investing in Japan is starting to pick up. The need for data centers and digital infrastructure is a really attractive theme. Energy in Japan is a critical issue for the Japanese economy. That's going to take a lot of capital and a lot of private capital to support that. You're also starting to see the emergence of private credit in this marketplace to partner and complement what the Japanese banks are doing. It's going to provide more risk capital and more sources of capital to Japanese companies and entrepreneurs. So there are a lot of different ways to scale our platform here in the market. And most recently, it's around insurance. We have a very large insurance platform called Global Atlantic. We are partnering with Japanese insurance companies to bring them solutions for their policyholders.
You talked about private credit, private equity. You talked about infrastructure. India comes to mind as well. This is one market that has enormous potential. How are you looking at the Indian market? They say that it is coming of age right now.
Yeah, India is an amazing country to invest in. After Japan, India is our second largest destination of investment in Asia. It's underpinned, I think, but by what everybody knows, 1.4 billion people, an incredible demographic story, an incredible consumption story. And you start layering on top of that, more recently, a manufacturing industry that's starting to blossom as well.
And what's the plan for infrastructure in India in particular? We know that this is a growing business for you. In fact, if you take a look at the numbers, it's grown from 13 billion in 2018 to 60 billion right now. And your Asia Infrastructure Fund has been looking to deploy capital, and India could be the biggest beneficiary. It sheds some light on the plan there.
Sure. I mean, India for us is a big destination for both private equity investments as well as infrastructure investments. Our Asian Private Equity Fund and our Asian Infrastructure Fund are the two largest vehicles in their asset classes in the region today. And India is a core destination. So already today in India, we've invested behind toll roads, transmission grids, renewable energy, and digital infrastructure. So I think we're just getting started, but it's going to be one of the largest destinations for infrastructure capital going forward.
It is hard to talk about Asia without looking at China. This is a huge market, but we know that when it comes to top PE companies, they've pretty much put a brake on, investing in the deals in China. What's your take on the environment there?
Yeah, given the current geopolitical climate, certainly the aperture of what's investable for us today is a little bit more narrow than what it was 5 years ago or 10 years ago. Our approach, though, is we have definitely not pulled back from the China market in terms of our commitment there. We just need to be much more tailored in terms of the sectors and the themes that we think are investable. Our focus really for the last 20 years in China has been focused on domestic consumption and value-added services, which we think is a sweet spot of the Chinese economy, actually. Just recently, we announced one of the largest control buyouts in China in the largest domestic branded soft drinks business, over a $2 billion transaction. So if it's in that sweet spot of domestic consumption, local champions, we're very, very excited to invest in China today.
Are you seeing signs of M&A revival? And what do you think it will take to see a real reversal in sentiment when it comes to the Chinese market?
I think the biggest positive catalyst for Chinese private equity, the industry, would be a clearer path to liquidity, to monetization. The stock markets need to open up so investors can exit their positions more easily. And the M&A market needs to continue to expand. It's going to be more probably sponsor to sponsor in the next 3 to 5 years. The strategic bid from international companies is probably not going to come back as quickly in China. But as the Chinese stock market improves, that path to liquidity, I think, is going to be critical for investors.
Joe, let's take a look at some of the macro trends happening today. We've been talking a lot about de-dollarization, how investors are pulling back from the USD. Do you see that? There is a debate. Where do you stand on the issue?
Yeah, I don't think it's a question of global investors exiting the U.S. market by any means. I think it's more a question of diversifying their portfolios with that incremental dollar. Where do you want to invest it? I do think it's fair to say that most global investors have a lot of exposure to the U.S. right now. And as the U.S. dollar weakens and other markets like Asia continue to have these fundamental tailwinds in terms of growth, I think you're going to see people diversify their portfolios more and more to Asia over time. And that makes sense in a multipolar world, right? As regional economies are becoming more important, as Asia is getting more dependent on intra-Asia trade and growth, I think you're going to see more and more capital flow to Asia. It doesn't mean they're pulling out of the U.S., though.
But do you see that getting momentum then, Joe?
I think it really depends on who you are and what your portfolio looks like today. There are clearly some investors that probably have really very large exposures to the U.S., maybe a lot of tech exposure to the U.S., and are looking to diversify. There are lots of investors in the U.S. that have very small allocations to Asia today. And I think that's going to start shifting as well with the incremental dollar of investment. They want diversification. They want access to the growth that people are seeing in Asia. And I think you're going to see more and more capital flow to this part of the world.
And that was KKR co-CEO Joseph Bay. Still to come, AI data centers are driving a massive surge in new energy demand. We'll discuss how the green industry can meet that challenge in an exclusive interview with BNP Paribas Global Sustainability Head, Jane Ambachtsheer, will be joining us. Keep it here with us. This is Bloomberg. Welcome back to Insight. Now, according to Bloomberg NEF, climate tech companies raised over $20 billion in funding in the third quarter of this year. That's already above the full year total for 2024. Clean power was the best funded sector, and it reflects the emergence of a new driver, the surge in power demand from data centers. Many companies are vying to become enablers of this AI expansion. Let's get perspective from Jane Ambachtsheer, Global Head of Sustainability at BNP Paribas Asset Management. Jane, welcome to the city. Good to have you with us.
Thank you.
Talk to us about how BNP and also your clients are thinking about sustainability.
It's a pleasure to be here. Thank you. Sustainability has been one of our priorities for decades. And we're really looking at it in two ways on behalf of our clients. First is as investors from a bottom-up perspective. how can sustainability risks and opportunities impact the companies we're investing in, the countries that we're investing in. So we spend a lot of time and effort working across our investment teams to make sure we have the right information, the right insights to bring that into how we're allocating capital. But to take a step back, most of our clients are long-term investors. Insurance companies, pension funds, sovereign wealth funds, and they're looking at market performance for the coming decades. And from this perspective, the energy transition, biodiversity loss, social inequality, these can introduce systemic risks that they're worried about and that they want their partners and their asset managers to be tackling.
So are you saying that despite the negative headlines we're getting, there's actually greater momentum, there's greater commitment from your clients, from governments?
I mean, I'm not sure I would phrase it that strongly. Certainly, we see the energy transition is inevitable. It's happening. What's at question is really the pace and some of the regional dynamics around the transition. So we see huge interest from a number of our clients. Some have specific targets around sustainability. Others are less focused on meeting specific sustainability objectives, but they want to make sure they have the best outcomes from a portfolio perspective, and they expect us to understand and integrate relevant financial risks.
How is that playing out? Talk to us about the investment flows, both in terms of the retail investors and institutional as well.
Yeah, so it's been up and down, but this year in Asia Pacific, for example, we're seeing increased interest and an allocation to fund flows from a sustainability perspective across a number of different countries in Asia Pacific. In April, we also had the Asian Investor Group on Climate Change release their annual updates around the number of Asian investors that have specific commitments around either tracking or having targeted allocations to climate thematic investments or a specific focus on nature and tracking deforestation. Across the board, the number had increased in terms of the number of investors that were focused on these areas. But it might not always be a huge headline. It might not be something that they're leading with necessarily, but it's something that I think quietly we're seeing more and more investors really become more sophisticated in terms of how they're tackling some of these topics.
So that's in Asia. Compare that to, investors in the US and Europe. How is that looking?
Yeah, well, if we start with Europe, we definitely see a huge portion of investors that have pretty specific sustainability policies or objectives and have very clear expectations in terms of their asset managers, in terms of both the products and services that we're able to provide them with, but also how we're using our influence in terms of our own proxy voting policies or our corporate engagement commitments around sustainability. So that's something where we've seen some more recent headlines in Europe in terms of asset owners articulating their expectations for their asset manager partners. Of course, in the U.S., we've seen a slightly different dynamic unfold over the last year with the political context around sustainability. So we've seen, a bit of the opposite in the U.S., where asset owners and managers have been less quiet around some of their sustainability commitments. But what's interesting, if you look at Climate Week in New York, for example, a few weeks ago, was actually the biggest ever in its 16-year history, with over 1,000 side events.
A surprise, given the headlines that we're seeing.
Right. So it was a surprise. And I think that there is still a lot of kind of work going on across a range of sustainability topics. And what we're seeing is a bit of a transition in terms of Asia Pacific, of course, really emerging from a really strong leadership perspective on a lot of different areas. Continued strong leadership in Europe and articulation of expectations with some simplifications along the way. And then in the United States, of course, we have a more fragmented landscape, but still a huge number of corporate and financial institutions that are doing important work on sustainability because it makes business sense for them to do so.
When we talk about sustainability, we also have to talk about sustainability in power, in energy, with a lot of talk to do with AI and data centers. How should we be looking at powering these data centers with clean energy, green energy? Where are we with that?
I mean, of course, it's a huge challenge and a huge opportunity, and something that everybody's watching, and we will see continued progress. And I think it's a big, both a technology and a policy related opportunity. And I think financial institutions need to play a role there as well in terms of having a seat at the table and looking for solutions and opportunities from a financing perspective. I think what we talk about less, perhaps, is also the opportunities that AI present in terms of tackling some of the climate and nature challenges. And that's another area where we're putting a lot of focus across the BNP group.
Right.
So
what's exciting? I mean, how can AI help? I mean, what are you excited about when you speak to investors and take a look at the technology out there?
Yeah, there's a whole range of topics. On the one hand, there's a company we're involved with called Kairos, which are looking at methane emissions, of course, the most potent greenhouse gas. And they've created a large language model really focused on satellite imagery, looking at how do you track methane emissions, which is being applied as a regulatory tool, but also as an investment tool. Another really cool company that we're involved with is called Nature Metrics. It's based in the UK, and it's environmental DNA. So basically, you can sample water or soil and put it through the lab and basically look at the genetic sequencing and understand all of the species which have been active in that ecosystem in the last week. And I actually did a tour of one of their labs and learned how to sequence the DNA of an onion with my kids. But I was talking to one of the scientists there, and she was in her 30s. And she said when she was studying biology, they went out into a boat in Lake Ontario in Canada, would dip the nets in the water and basically have clipboards and catalog all of the species that they were finding. And now they just, scoop up some water, sequence it in the lab, and I mean it's transformative in terms of how efficient they can be. So if you think about the fact that more than half of GDP is linked to ecosystems and nature, reliant on nature. And if we think about the role for investors, companies, and policymakers then to track the health of ecosystem services, to be able to have this kind of technology is incredible in terms of increasing the efficiency to be able to set targets and track them.
Are you concerned, though, that we'll be unable to power these data centers that enable AI to be used to solve some of these problems? We're talking about insatiable appetite. We're talking about a doubling of, energy demand by 2030. That's a huge amount.
It is a huge amount. And if you look at China's recent NDC and commitment going into COP30, for example, it included a 30% commitment to have clean energy sources in the power by 2035. So, I mean, it's progress, it's movement in the right direction, but you're right, we're not there yet. And I think we have to deal with these competing challenges around increased demand for energy and how we supply it in a sustainable way. And we haven't figured it all out yet.
And what's the biggest concern for you when it comes to that?
Yeah,
not there yet. I mean,
yeah, it's around the locking in of high carbon sources and some of the trade-offs that we need to make in the short term. And I think that's why some of these policy discussions are so critical now in the coming kind of short-term years, because we're locking in power sources for decades.
Earlier we talked about continued commitment in sustainability. We're suddenly seeing that in terms of sustainability debt issuances. The numbers have been quite staggering and quite surprising. What are your own expectations? And would Asia be driving that as well?
Yeah, I mean, this is perhaps another area where we don't see as many of the positive headlines. But in fact, sustainable debt issuance in Asia this year in 2025 has already exceeded 2024 issuance. So we're definitely seeing a trend in the positive direction. I think one of the additional interesting things is the ongoing kind of expansion of the different sustainable taxonomies. So as we look at, the fact that we've got, more than 30 or even 50 sustainable taxonomies around the world, we're seeing in Hong Kong, for example, we have the first taxonomy to specifically introduce elements of physical risk. So looking at adaptation, resilience are different areas where we haven't seen a lot of debt issuance yet, but I think that will be a growing area. And of course, transition is another area where we're having a lot of discussions around how do you measure that, how do you make sure that some of the commitments are transparent, trackable, measurable, et cetera. So I think definitely we're going to see more on that front, and that Asia Pacific will lead the way.
And speaking of commitment, COP30, I mean, how optimistic are you that we'll see some tangible results?
Yeah. I think we have measured expectations going into COP30. Of course, the majority of countries have not yet submitted their NDCs, their nationally determined contributions, which is unfortunate. I mentioned, China, of course, has an absolute emission reduction target out to 2035. So a reduction of 7 to 10% from a peak, which should be around now. So, that's very clear, and I think setting a good example in terms of having accountability and transparency in the right direction. But as I mentioned, look, things are moving in the right direction, but not at the right pace. And so I think that's something that we'll be looking for coming out of COP. Some of the specifics around carbon trading mechanisms, around progress on Article 6, clearly linked to nature-based investing, which is a theme that we're very focused on, many in the region are very focused on. Around how do we create the right incentives. So I think that is a tangible area where I think we'll see some progress coming out of COP. I think it's important to note as well that the UN Principles for Responsible Investment are hosting their annual meeting the week before COP in Brazil. And you've got over 5,000 signatories, $125 trillion in assets signed onto the PRI. And so I think that's a strong signal as well, the fact that that's taking place in the region the week before COP. So I think that should help to create some momentum in terms of the financing challenges.
You talked about how it's not moving at the right pace. Can you accelerate that pace without the leadership of the U.S.?
That's what we're working on and looking to figure out as a community. And I think it's coming back to the fundamentals of why are we working on this, right? There's environmental and social crises we're looking to avert, as well as economic resilience. Right. It is in our interest as a global financial community to mitigate the worst impacts of climate, biodiversity loss, and systemic inequality. And we're here to create value for our clients at the end of the day. And those are priorities that are set. And so I think, the political environment evolves over time. But as long-term investors, we need to really stay focused on those fundamentals. So what is the right environment to bring together capital allocators, public policymakers, regulators, companies together in this forum? And so COP30 is one of them. This week in Singapore, we have the Sustainable Finance Advisory Panel for MAS, which is why I'm here in the region. Of course, MAS has shown a ton of leadership in terms of bringing together different stakeholders to tackle these challenges. So I think as others step back, others need to step in, and that's really the exciting part of what's going on right now, to see how do we shift some of those dynamics to continue to improve and address the challenges at the right pace.
Jane, great insights. Thank you for joining us today.
Thank you for having me.
Jane Ambachtsheer, Global Head of Sustainability at BNP Paribas Asset Management. Now, a quick look at the markets. Let's take a look with India still on holiday. We're watching 1-month Indian rupee NDFs, according to our markets live team. Rupee forwards are jumping on a local media report that New Delhi and Washington are closing in on a trade deal that could lower tariffs for Indian goods to as low as 15%. We'll be watching when Indian markets return from holiday tomorrow. We're also tracking Indonesian assets ahead of the central bank's latest rate decision due after our show. A majority of economists expect Bank Indonesia to cut rates for a fourth straight month, part of its pledge to go all out in supporting economic growth. President Prabowo Subianto is targeting 8% annual growth by the end of his term. And before we go, here's a look at our guest for tomorrow. We'll discuss the outlook for fixed income with PineBridge Investments' Omar Slim. Former ECB President Jean-Claude Trichet also joining us live from the Bund Summit in Shanghai. Plus, we'll discuss JSW Steel's growth strategy with its CEO after their second quarter earnings miss. And that is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.